Hello viewers, welcome back to our YouTube channel, KC Accountants Education Center. And today we want to start with financial markets. So when you look at the syllabus, the topic says, if you look at the syllabus, this topic, they talk about it as securities and financial markets. That's the topic which we started with in the previous videos. That is the topic. But we first looked at how we mobilize money. In other words, we looked at the finance decision. We looked at how we mobilized money to finance our activities. But right now, what we are going to do with financial markets, I want us to focus on what we refer to as the financial markets. These financial markets, they are the ones that I want us to focus more on. Financial markets, they are traded on the stock exchange. They are traded on the stock exchange market or stock market. Those are the financial securities. So we want to look at these financial securities as those securities that are traded on the stock market. And that's what I want to focus more on, these financial securities that are traded. Those that are not traded on stock exchange, we are not more interested in them. And the other thing is that these securities, they are supposed to be long-term in nature. In other words, we are looking at long-term financial securities. Long-term financial securities. They are the ones that we are looking at. Now, we want to understand, we don't care whether these are debt, whether they are equity, but as long as they are long-term financial securities and they are traded on the stock exchange or the stock market. We are just going to highlight these financial instruments. One, we have common stock, and we say this is what we call the ordinary shares. We also have what we call the debentures, or what we call the bonds. We also say they can be loan notes. The other, we can have other instruments, those like commercial paper, but these other ones, they are now on what we call money markets. And it's where the money market is where we trade for the short-term sources of finance. The short-term sources of finance that are traded on the stock market. So the examiner has been asking about the nature. The examiner has been asking about the nature and roles. It has been a combined question, nature and roles of financial markets. And there is when he asked for, sometimes he separates for them, sometimes he asks it in this same way, nature and roles of financial markets. And there are sometimes when he asks it for nature and roles of the commercial banks. May not ask for financial markets, but asks for commercial banks. And I want to tell you that the answers are the same. The laws and nature of financial markets, and then the nature and laws of commercial banks, those, they are the same. So for both questions, even for commercial banks, they work hand in hand with the stock markets, because we also know that financial institutions like banks are one of the major players in the capital market business. So when the examiner asks about the nature, specifically if you look at the nature of financial markets, in other words, who forms the financial markets? So when they talk about the nature, it's basically talking about who forms or who are the major participants. And we have, among the major participants, we have insurance companies. Let me just write it. Among the major participants, we have insurance companies. Can also call the insurance companies and banks. We have Forex Bureau, those that Forex business, those that are into exchange of currency, Forex bureaus, because if you go to the stock market, you may find that they deal with dollars, they deal with different currencies. So you need these Forex bureaus so that they are going to help you manage foreign exchange losses and other aspects that may arise. So this question has been coming in very many different papers, the nature and laws of financial markets. It also happened in December 2021, question 3. So don't underestimate this question, because it has a potential of taking up to 8 marks or 6, depending. So you don't need to underestimate. So we need to first get to an understanding of the nature of financial markets. What is the nature? If they talk about the nature, what do we include? Now, financial markets. Remember, here we are basically looking at the financial markets in Uganda. Financial markets in Uganda, they comprise of what we call capital markets. And I'm going to explain later what capital markets are. Because there is also what we call money markets. But we have to understand what these two means. But first of all, you need to understand the fact that financial markets in Uganda, they comprises of capital markets and then the money markets. So they are made up of capital markets and money markets. However, these capital markets, these are markets. Of course, if I'm to write, these are markets, or a capital market is a market on a stock exchange that deals in long-term sources. It deals in long-term securities. Whereas this money market is a market on a stock exchange that deals with short-term securities. And the short-term securities, the good example that we can talk about for short-term securities, we can have a treasury bills. Treasury bills. treasury bills as our short-term finance. So that's one category. We have the nature, we have the capital markets and then the money markets. Two, we also have we have also got what we call the insurance companies. I had talked about them. Insurance companies. I've got insurance companies. And these insurance companies, of course, they are trading in what we call the insurance markets. And these insurance markets, they are the ones that are dealing with all the insurance products. We've also have the foreign exchange markets. Foreign exchange markets, which deals with in sale and purchase of foreign currency. We also have the ones for mortgage markets. And these, they deal in loans for specified period of time based on residential and commercial properties. So those are some of the things that we can talk about as far as the nature is concerned. So when they ask you about the nature of financial instruments or financial markets, make sure you highlight the different markets that we have, from the capital markets, the money markets, you talk about the insurance markets, you talk about the foreign exchange markets, the mortgage markets, and what they deal with. So let's look at now the roles of financial markets. Laws of financial markets. Just going to give a few of them. One, these financial markets do what we call financial intermediation. So they do what we call financial intermediation, where they get money from those who have it and they give to those who don't have it. So they get money and also they give it out. They give it out in form of credit to those who need it. They facilitate business. How do they facilitate business? By facilitating trade, by making markets dynamic, where funds are transferred from one place to another. That's how they help in facilitating business growth or growth and development. So they facilitate trade by making markets more dynamic, whereby funds can be transferred easily. They also generate wealth. They generate wealth. So the people who save money, the savers, are able to generate income. And how do these people do? They go and buy shares. When they buy shares, they are going to be earning dividends. So the people who save money, these financial markets will help them to buy shares and be able to create more income or more wealth through buying those shares. Because in the process, they will be able to be getting dividends for their money. We also have absorption of financial risks. So when we bring in many items or many markets that are going to help us give people money, because everyone is going to be bringing in their shares, and at the end of the day, we are going to have economies of scale. those stock markets are going to have economies of scale, and we will find ourselves, we are able to manage the financial risks. So if an investor is unable to bring in money, then others will actually bring in money. So by having very many companies that are listed on the stock exchange, it creates a very bigger space for people to bring in more money for investment. So it will be like a platform that will help to absorb the financial risks, because the resources may not be available. You may go to the bank and you want to acquire a loan, but they may not give you the money that you need. And the only way you can raise that money is through shares. So as many people are coming in, as very many markets are opened up, it gives the stock market a very good platform where very many people can be able to bring in money. If this one doesn't bring, the other one will bring. It means you will find a way to sort the financial crisis. The other that we can talk about is provision of liquidity. Provision of liquidity. In the stock markets, money is always there. So when there is no money in the public, let's say the company doesn't have money, they can go to the stock market and get money, or they can issue more shares and they get money. So that's, they provide liquidity. When you need money, money is always there. If money is not there, if you have a lot, then you can invest in other companies so that you reduce your liquidity and be able to make more, to generate more wealth. So those are some of the points that we could think of. You can add on more, because there are very many points that you can talk about as far as the laws are concerned. But if they give you the nature and the laws, make sure you explain it in that perspective. You highlight the different markets that we have. You explain what they do and what is traded there. Then you also bring in the laws. So take note of that question. Then let's look at the types of financial markets. I know it's almost the same thing like what we looked at, but there is something I want to clarify. Something small about these types of markets. Now, we have already discussed that we have capital markets, and at the same time we have already discussed that we have money markets. So those two are done, and we have agreed on the difference between the two, where we said that this money market is used for short-term securities, and this one, capital markets, is used, or it focuses on the long-term securities. However, there are other two types of markets which they confuse a little bit. They confuse students a little bit, and those are the ones that we call the primary market, and then what we call the secondary market. And when we understand this, that will be that as far as financial markets are concerned, because we just want to get some brief key things that we see that are very important, we shouldn't exclude. So now, for primary markets, we need to understand the difference between the primary market and then the secondary market. We need to get the difference. So a primary market is a market where shares are listed. Let me write it. Primary market is a market where shares are listed for the first time. are listed for the first time on the stock market or stock exchange. In other words, primary market is all about the first time an organization issues its shares to the public. Now, what happens is that when an organization is issuing shares for the first time, we call that process the initial public offer. It is through the initial public offer. These are some of the processes. Initial public offer. That is the process that the company that has been listed issues its shares for the first time. Now, the primary market is stopping at the point when this primary market is closed, like when the initial public offer, they call it IPO, is closed. Then after that time, then it will be what we call the secondary market. So the primary market stops at a point when the initial public offer ends. If we are supposed to issue shares maybe from 1st December 2024 to maybe 31st December 2024, the whole of this month, by the time it closes this, if this is the period for IPO, by the time it goes maybe to 1st Jan 2025, then it will be a secondary market. So a secondary market is a market where shares will be traded after the initial public offer has closed. For example, recently we saw MTN issuing its shares or floating shares on the stock market. They issued their shares for the first time. But when that process ended, don't think that MTN is no longer selling its shares. You can go to the stock market and buy. So where you can buy now is through the stock market. You can't buy it from the primary market anymore because it closed down. So what is going to happen is that for you to be able to buy shares from the stock market, you must go through what we call the stock brokers. You can't just buy shares alone. You have to go through the stock brokers. They are the ones that are going to help you sell or buy your shares, get the buyers, and also make you buy shares. So the secondary market it has very many people who are going to be participating in it because it goes all the way. It's infinity, or it depends upon the life of the company. But of course, we expect that by the time the company is listed on the stock exchange, we expect that company to be a little bit stable. It's not that company that is just going to collapse there and then, because there are criteria for you to first get listed, which are sometimes financial and others. They look at other key aspects. So that's basically what I wanted us to discuss as far as this is concerned for the financial markets. And in the next video, we are going to look at the cost of capital. The cost of capital, whereby we shall be able to look at some of the relevances of cost of capital. The relevances, those are importances or the objectives. So let's go into the next video as we are looking at the cost of capital. We see you there.